Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, it was another very volatile session in the markets. Overall, as you can see, everybody had a turn. We started off the morning with a very beautiful gap up open on the SPY. 0.5% in the green on the SPY, 0.8% on the QQQs, and then it unraveled all throughout the day until the last few hours of the session, where we got a little bit of a bounce. Everybody got a turn, the bulls, the bears, and then the bulls again. You might notice that every single day this week, it's been very volatile ever since the jobs report came out last Friday. There is two very clear narratives that are kind of going at each other right now in terms of a battle in the markets, a battle of opinions. And since June and July, which were relatively easy months in the market, there wasn't too much volatility. The trend was very clear. In the most recent 5 days of trading, guys, you have seen a clear uptick in volatility. And on the Monday session, we kind of explained why, because the dynamic has shifted a little bit. Prior to Friday, prior to the jobs report, you had very bullish seasonality, talking about the summer months being very good for the markets usually. We also had very decent earnings reports to look forward to. We also had the fact that tariffs were postponed and paused. The jobs market was still okay, not showing many signs of weakness. The inflation was still in check with slight little upticks here and there. And the Fed was saying that the policy was restrictive, but not hurting the economy. Since Friday, that has all been kind of flipped on its head. Since Friday, we do not have any more bullish seasonality. You'll notice that fall is usually somewhat choppy for the markets. We also have no more earnings to look forward to. The tariffs are no longer paused. All of the effective rates have now been in place since the Friday session. The jobs narrative right now is definitely not okay, depending where you look. New jobs creation is a bit slower than anticipated, but the economy is still working at full employment, meaning that nobody's really getting fired. Unemployment rate is still 4.2. Inflation, right? If CPI comes in hot again next week, that's going to be 3 months. So the inflation narrative is starting to come back a little bit. And now number 6, the hottest topic of the hour since Friday, will the Fed have to pivot? The new rate cut odds for the month of September, I will remind you, are currently standing at roughly 92% and possibly another cut coming in either in August or December. So 2 cuts for the rest of the year. Now, in terms of today's action, guys, well, once again, we had something come into play early in the morning where that kind of gave the markets a bit of a bearish lean towards the bearish narrative. And that was one of the Fed members that was speaking, more specifically, Fed member Bostic. And he's usually been known to be quite hawkish and somewhat bearish on the stance of the economy over the course of the past year. But here's what he had to say at 10 a.m. and the markets kind of unraveled from his speech. Tariffs may push prices up for 6 to 12 months, hitting small businesses hard. The economy is slowing. The jobs market is volatile. Consumers are stretched with pay later programs and likely to see only one rate cut for 2025. There's a lot of dissent between Federal Reserve members right now. As a matter of fact, the most amount of dissent within the committee that we've seen in over 30 years. Just goes to show you how strong these two narratives are right now. Now, what member Bostic said today is kind of contrary to what the Bank of America CEO Brian Moynihan was saying just yesterday. Bank of America feeling that the economy may grow 1 to 1.5% with no recession. That is what Brian Moynihan's team of economists was saying, essentially. Moynihan adding that credit quality is strong and borrowers still have room to take on debt. On the labor front, he notes 4.2% unemployment sits below most full employment estimates, so future job gains will be limited by available workers rather than weak demand. If consumers keep this up and the job market stays tight, we could see a year without rate cuts and no recession. Curious. So even though Brian Moynihan's team is saying that, yeah, the economy is strong, and that is also what the Fed said at their meeting last week, they said it's slowing but strong, and they said that so far, there's no indication that the elevated stance of the interest rate right now is hurting the economy. Well, still, he is projecting for no rate cuts by the end of the year. And Fed member Bostic also saying maybe only one cut. However, the market, analysts, and obviously institutions and what, they are now pricing in 2 rate cuts with a almost certainty in September. So it just goes to show you how bifurcated the market is right now between these two narratives. It just cannot make up its mind, which is why the price action recently has been very volatile with an upward bias because earnings were very strong. But you can clearly see it in the VIX as well, right? The VIX has been somewhat elevated in the last 5 days of trading. There seems to be something every single day of this week so far. So in today's video, guys, we're going to cover a few key things together. Number one, as per usual, I have a few earnings reports prepared for you guys, and those are going to be looking at TradeDesk, Celcius Holdings, and lastly, we're going to take a look at AppLovin, which had their earnings yesterday. Now, shout out to all the other interesting tech companies out there that reported earnings. We will cover some of those tomorrow. So my plan for tomorrow is probably going to be covering Duolingo, Fortinet, Symbotic, and maybe one other one, such as McDonald's, Disney, maybe Oscar Health, some things of that nature. So we will definitely get to Symbotic, Duolingo, Fortinet, because they had pretty big moves, of course. We will do them tomorrow. But for today, we'll focus on some of the stuff that came out today. Celcius and TradeDesk both having very big moves, and AppLovin as well. And maybe into next week, because next week we don't have a lot of earnings, right? Take a look here. This is next week. Right across my shoulder, right about there. You can see next week is when earnings really winds down. So maybe we can play a bit of catch up for the ones that we missed. But today, that's going to be the plan. After we are done with our earnings, we will, of course, get into our technical analysis of our major stock market indexes, see how the rotation was playing out, because there's a very strange market today. You have a lot of very nice gains, but also a lot of very big losses. And we'll kind of gauge how is the market rotation going? How is the market breadth also shaping up into the month of August? Thereafter, we will do a technical analysis rundown on our major big tech names, derive which of these big tech names still represent some decent buying opportunities for short-term trades or for long-term portfolios. And at the end of the video, yes, we will go over the biggest gainers and losers of the day today. There were many, both big names in the green today and also very big losses across the board. So there was definitely something for everybody today. Hopefully you guys made it through the day just fine. So with that being said, guys, let's jump right into the action right away, shall we? The SPY today down 0.08, the Q's up 0.34, but take a look at this heat map. Very strange market, very bifurcated market today. Microsoft down, but Apple up 3%. Some of your technology names like cybersecurity and whatnot, because of Fortinet earnings, they were all down multiple percentage points. Amazon, Tesla, Google, NVIDIA, not too bad, but once again, the semiconductor landscape remains somewhat mixed in favor of the data center plays. But the other ones, in terms of personal electronics, not performing too well. Look at software. Supposed to be one of the biggest beneficiaries of AI efficiency gains. Software has done nothing. Not only today, look at the past 1 month in software, guys. It's been abysmal, absolutely abysmal. The same can be said for most semiconductor plays. I mean, besides NVIDIA, Broadcom, and AMD, and TSM, which is not in here, what has been going up in semiconductors? Not much. And this list shows the same thing. If you move back to the one-day relative, you'll see that the banks were affected by Fed member Bostic's comments this morning and never truly recovered at any point today. Healthcare was good, except for Eli Lilly, which somehow dropped 14% after earnings. Consumer defensives were okay, and the bottom half of the market, once again, very mixed. So if I put this back on a 1 month relative, you can see how bifurcated the market actually is. The conclusion is, other than a few names such as Walmart, of course, and maybe Pepsi, if you're not doing AI, if you're not part of the AI narrative, it's just not working right now, right? Apple, all the hyperscalers are doing well, even Apple, not Amazon so much. Look at the cybersecurity names in the past few days, right? Palo Alto Networks down 18, CrowdStrike down 17 in the past month, Fortinet down 30%, and many more. Semiconductors, same concept, other than the big few. A lot of that sector is down high single digits or double digits. Banks and financials, definitely not doing too well. Visa's down 7% in the last month, despite having very good earnings. Healthcare, well, we already know what healthcare is doing. A whole bunch of nothing, multiple percentage declines right there, especially in your biggest players. And the bottom half of the market right here, still doing nothing. Consumer defensives, okay, but a mixed bag. Industrials, really only the defense contractors, contractors such as, GE and RTX and those guys, those are doing fine because they're getting a lot of money from the tax bill, essentially, the big, beautiful bill. Other than that, in terms of specialized machinery, only GE, Vernova, and a few others that are associated with the power ramp Utilities, a lot of the natural gas and electricity players are doing well because that's associated with the AI trade as well in terms of powering it all. But look how many names, guys. This market in the past month has not been so smooth. Essentially, from the bottom on the SPY through the April and then May and then June rally, that was the everything rally. Everything was, flushed after the tariff episode, and then it was the everything rally. The market was fairly broad. In the past month, though, you've seen a separation of the market. Basically, AI and AI affiliated narratives versus everything else. And everything else has really been a big pain point. So depending which stocks you are invested in this market, over the past month, you may have been having a very good time, or maybe your portfolio is even flat or red. Really depends what you've been invested in. But I figured that should be notable to bring to you guys. On the one-day relative, you can see the mixed market that we had today. Materials, utilities, defensives, technology, real estate, cyclicals were actually higher today. To the downside, everything else, led by financials and healthcare. On the 1 week, same thing, guys. Very bifurcated market. Materials and defensives, your two best performers. Odd. Energy to the downside. And the 1 month relative, even though we do have a lot of gains, we've retraced a lot of the gains so far that we had in the month of July. And even though some names have been able to recover from Friday's decline, it's definitely not everybody. A lot of names have actually pushed further and further from that Friday sell-off. So guys, before we get into more technical analysis, let us dive right into our earnings. And we're going to start off with a very fun one that, you guys might remember because we haven't done it for a while. Celcius Holdings. So Celcius Holdings, the company that went up a fantastic amount here in the 2023 to early 2024 period, from April 23 to April 2024, 255% rally. And then, since then, nothing but downside almost until the tariff bottoms. And then essentially from some of the tariff lows, you are now up 127%. So we are going to seek to understand Celcius Holdings. Are they through a lot of the damage that was caused to the brand and to the stock price recently? Right? Or is this maybe just one that you should still potentially avoid? Let's move into their earnings, shall we? So their earnings, beat on EPS, they smashed it, guys. 56% beat on EPS and a 12.75% beat on revenue. However, not all of it is organic. I'll remind you that they did acquire Alani, which is a very big energy drink company. They acquired them for $1.8 billion in cash and stock. This is the first full quarter where we have the numbers, the combined numbers between Celcius and Alani. And there's a bit of a discrepancy between where the revenue is coming from for CELH right now. The problem that CELH had right here was the fact that they were unable to grow revenue. This company used to grow revenue by a very fast margin prior, but in the past few quarters, I mean, this doesn't show it so well. This kind of shows it a bit well, right? You'll see this is the blowout quarter from today. But the problem with CELH was flat revenue growth for the past 6 quarters. This was a company growing revenue high double digits and then down to single digits and then just flat overall. So now we are seeking to understand, are they back? Is revenue growth back as a whole? Or might the numbers be inflated by the Alani acquisition? Let's move into it, shall we? So beat on revenue by 84% year over year. That was very good, but a big portion of this is from Alani, from the absorption of their sales into this company's brand. EPS up 68% year over year, net income up 50% year over year, and adjusted EBITDA as well, doing very, very well. Moving into some of the commentary from the CEO here, Celcius Holdings delivered strong results in the second quarter, supported by solid sales growth for the Celcius and Alani new brands and operational efficiencies across our business. As momentum builds across the energy category, our brands continue to lead, driving household penetration, expanding shelf space, and outperforming expectations. Matter of fact, their net margins were not so bad, 13.5% to be quite precise. Monster Beverage, comparing and contrasting between two similar companies, is 20 to 23% net margin. So Monster Beverage having a lot more scale and better net margins overall. And I'll remind you, Pepsi still owns 8.5% of Celcius, and they do control most of the distribution for this brand overall. Let's move into some of the numbers here, guys. Some of their investor presentation numbers, and I'll show you some things, guys, that just kind of rub me a bit the wrong way. So you will see here first that they are the #3 energy drink portfolio in the United States, second only to Red Bull and Monster, with total US market share of 16.8% in the first half of 2025, which was very good. Gross margins coming in at 51.8%, which is also towards the top end of the company's historical average right there. However, take a look at these statistics right here. I mean, they gloss over a lot of things that they did well, but one thing that stood out to me here, the Alani new brand delivered 129% year-over-year retail growth. So you'll see here, record Q2 revenue, 84% year-over-year. However, Alani representing $301 million of contribution to that 739. How much did good old legacy Celcius do? The Celcius brand's retail sales grew only 3% year-over-year. So Alani contributing most of those gains, which is good because they acquired the business, right? So obviously it's a good synergy for them, but still, right? Not too excited to see that the Celcius brand was only growing 3% year over year. There's a lot of competition in energy drinks, guys. You probably know when you go to the corner store, there's like 5,000 different energy drinks to kind of choose from right now, yeah? Take a look at their revenue growth in North America. That was very good, 87%. But once again, a lot of that was driven by Alani, which is okay because it's part of the company, right? But you still want to see the legacy Celcius brand kind of still be popular with consumers out there. International grew very well at 27%, but it's a very small fraction of the revenue, but still not too bad at all. And as I was saying, the gross margin figure of 51.5 is slightly off the previous quarter, measuring 2Q, not previous, but last year, 2024 Q2, 52%. So they are protecting that, and net income margins was pretty good. Celcius Holdings is growing the energy drink category overall. Here are your CELH retail sales across tracked channels. You can see that in the last 5-6 quarters, guys, right? You can see it was kind of flat, and now they add Alani, and now they're growing really well. Contribution to category growth by year, CELH representing 27% of the entire category growth. So all energy drink. However, you can see clearly here, guys, that since 2024, there's been a drop off, not only in Celcius, this is the entire category. So the category overall has pulled back a lot in the last 4 quarters. Now we're starting to uptick a little bit right there. Moving on further, Celcius Holdings retail sales, you can see that this is your, essentially your corner store and grocery store and dollar store sales, right? So you're seeing here that Celcius Brands is improving here. This is a monthly chart, so don't get it twisted, right? You'll see here that over the 4 or 5 last months, they've been doing well, but prior to that, they spent about 8-9 months doing absolutely nothing. So it's nice to see them move back in the right direction, get back on track. And here's your Q2 market share, 17.3% across all channels. Monster Beverage sitting up there at 26.8 and Red Bull 36.8, but there is a lot of various different names in this industry overall. There's a lot of competition to be had, right? Here is your energy dollar share overall. You can see here that Celcius is the black line down below. They continue to gain market share. Monster is the green line. They are slightly losing market share every now and then. I mean, from their peak in 2022, they have lost about 5%, not only to Celcius, but also to all these different other brands, which have some pretty interesting offerings. Red Bull stays planted up here, still going very strong, 38% market share. So they are the only ones that really have not dropped off. They're the king, and they could remain the king for a long time. Celcius Holdings consolidated revenue. So if you see this big bar right there, that is with the acquisition of Alani and the absorption of their sales pipeline into the company. But prior to that, as you can see, for the past 8 quarters, it had not been growing. And if you were to remove the Alani brand, well, of course, guys, Celcius Holdings, as I showed you, 3% year over year only. So that is the only thing that's somewhat concerning from my perspective, is the fact that, well, Alani as well is going to be beholden to the same thing that Celcius had. You grow so fast, then eventually the growth rate tapers off, right? Everybody that has potentially wanted to try your drinks has tried your drinks, and then they either revert back to their classic go-to Monster or Red Bull or some other competitor, right? But it's always fun to see new brands in the space. That's when they get the most attention, but thereafter there is a drop-off. This is the common theme in food chains. It's the common theme in sometimes apparel brands as well when the trend is very hot. And You know, it's kind of it's in right now, but now Celcius Holdings, I'm a bit not worried, but you know, I have to look at this from just an objective perspective. I love the brand, I love what the company is doing. However, there are a few red flags here with the Celcius Holdings legacy brand. Revenue in the past 5 quarters, you can see that 84%, but once again, that is due to the expansion of Alani. International sales continues to be a good point for CELH, but still, guys, it needs to be a bigger portion of their business, right? They do very well in North America. International expansion, though, has been going well, but internationally, there's even more brands to compete with, so keep that in mind. Gross profit margins, you can see, I mean, it's the same percentage, right? It's just that they made more money. So overall, the adjusted gross margins were pretty good, but the EBITDA margins have been seeing a nice little uptick. So the company definitely is controlling costs where they can. So that being said, guys, it was kind of a mixed report for me. Celcius Holdings today was up 17%, and investors should be happy. But is this company a buy? Will it be growing the same as it has before? Well, let's take a look at some of their projections real quick. You'll see that EPS is on a steady trajectory up and to the right. And also revenue, guys. This big boost in revenue, of course, is because they are assimilating Alani's revenue into themselves, but still the revenue run rate is a far cry from what it used to be just a few short years ago. That being said, the revenue growth rate for the next few years is 18%, which is very respectable. The EPS growth rate for the next 4 years is also 25%, which is very respectable. At $55, is this company a buy, yes or no? It's trading at a price to earnings ratio of 57.9. They do have good EPS growth rate. It gives them a PEG ratio of 2.31. That's a little bit high. Anything under 1 is very cheap. Between 1 and 2 is okay. As soon as you start getting above 2, you have to ask yourself some questions of, do they deserve this growth multiple? Price to sales is 5.8, which is okay. Monster Beverage right now, which trades at $60 per share, and which is a more, I would say, more established brand with a lot more revenue, right? I mean, CLH is still a relatively small company, guys. They do like, you know, almost $2 billion in sales. How many sales does Monster do, though? Monster does a lot more, guys, and Red Bull does even more. Monster last year brought in almost $8 billion with much better net margins, right? So Celcius Holdings has a smaller price to sales of 5.8. And Monster has one of 7.25. So you can argue that Celcius is somewhat undervalued in relation to Monster Beverage in that whole respect. Now, if you want my end of the day, opinion on this one, it's okay. It's just okay. I'm not as excited for being a Celcius Celcius shareholder as I probably once was, especially back here. You might remember I started the channel in 2023, and even in 2024, I was playing a lot of Celcius, guys, because the growth rates were there and we hadn't hit the peak of their possible growth rates. But now that their growth rates are being tapered back a little bit, they're growing through acquisitions now and not so much through organic revenue growth, which is fine. There's multiple ways to grow revenue. I'm not, it's suffice to be said, I'm not going to fault them for that. But still, it is not my favorite company in the market. There are other tech companies that are growing at these same multiples as well. And the landscape for energy drinks, guys, is very competitive. They're not only competing with other cold energy drinks, they're competing with a bunch of other caffeinated beverages from the likes of McDonald's or Dutch Bros or Starbucks or Dunkin' Donuts. Keep in mind all the various aspects of how a person can get their fix in terms of caffeine, right? Which is essentially what this product is overall. So Celcius Holdings, the valuation is not bad. I'm not going to lie. If I do see it pull back a little bit, let's say we pull back from their earnings, back down maybe into the $40 range, you might see me play some short puts here. The one thing I'm probably not going to do is load up leap call options and think we're going to go back to $90. I don't think they have the growth to actually support a super quick rally to the same effect as we saw back there. We know that the whole segment, the whole niche of energy drinks has been somewhat soft in the last year and a half. So I'm not going to be buying any leap call options for Celcius. I think there's better plays out there. And in terms of long-term shares, I mean, I think there's also companies with much wider moats. I invest in companies for a long-term portfolio. The company needs to have a clear competitive advantage and a clear moat. I just don't think Celcius actually has that right now. They're a great brand, they're loved by many, but do they actually have a moat and a true competitive advantage? Or are they just one of many different energy drink providers? So I'll leave that final conclusion up to you, but those are my thoughts on Celcius Holdings. Hopefully you guys enjoyed that. Now for company number 2, one that people really do love unanimously almost, it is going to be AppLovin. Oh, and by the way, before I forget, in terms of for the swing trade for CLH, because I always include that as well, in terms of the swing trade, guys, it's not a bad proposition right now, but are we expecting a 2x really quickly? Probably not. In terms of a swing trade, it might have to be a longer term position trade in terms of like a maybe next 1 to 2 year outlook. I do think Celcius can probably make its way back into the 60, 70, 80s, but will we see massive rapid growth and massive expansion back to the all-time highs and beyond? I'm not too convinced right now, right? Monster Beverages market cap right now is sitting at about, let's call it about 59, 60 billion. Celcius Holdings right now is a smaller company, but they are sitting about 13 billion. So we can possibly go to, over the next 12, 18 months, maybe sometimes back to the all-time high or close. But as I said, it's not going to be quick. And they do face a lot of competition, so please just keep that in mind. But in terms of a super short-term burst of growth, I'm not quite seeing it for this company right now. So that's everything for that. Now let's actually dive into AppLovin. So AppLovin coming out with their earnings yesterday, and as a matter of fact, they absolutely crushed it. Initially, though, the reaction was somewhat negative to this earnings release. You can see that when they initially came out, it was down 14%. But then the CEO delivered a very strong earnings call, and from the bottom to the top of today, that's a 35% swing, massive swing. At the end of the day, they were up almost 12%. So let's have a look at some of their earnings, guys, because this one is a very popular name. Is it investable right now at $436 per share? Let's have a look at their numbers. EPS, 22% beat on EPS and a very nice 3% beat on revenue as well. Let's have a look at some of the easy numbers real quick. You will see that they beat on revenue. Well, they came in on revenue 17% year over year. Very strong. There's a slight exception to this revenue metric, and we'll talk about it because some outlets are reporting 70+ revenue growth. I'll explain why they're saying that. Adjusted EPS was up 169% year over year. That was absolutely fantastic. Companies growing margins and profits very aggressively. Net income up 164% year over year. This net income figure here is absolutely fantastic. It is the best margins that they've ever had. 65% net margins. Q1 was 39%. And I'll remind you, not that long ago, AppLovin, while it was scaling, used to be a net margin negative company. They've always had very high gross margins, but operating expenses and whatnot, we're kind of tapering back from bringing the money back to the bottom line. But now this company's been showing excessively strong net margins. And a lot of that has to do recently with the sale of their gaming business, which we'll get into as well, which is pretty much brand new. I mean, they're just about to offload it, right? But the margin gains from that gaming business sale will also be pretty good. Now they're going to entirely focus on the revenue driver that's really doing it for them, which is advertising. But look at these net margins. Look at that expansion. That's exactly what you want to see if you are a shareholder. Moving on to, that's not AppLovin, that's Celcius. Adjusted EBITDA up 99% year over year. Just goes to show you guys, their earnings profile is very strong, very resilient right now. Let's move into the article, shall we? So, AppLovin CEO sees benefits from Apple Epic fallout as stock pops on earnings. Let's see what he had to say. Is this going to be better for the company? The stock popped 12% and is now up 35% for the year after soaring more than 8-fold in 2024. Wall Street has piled into the company due to its growth from AI technology that's given advertisers more ways to target users in mobile games. They are the mobile game kings, guys. They do the best advertising that you've probably ever seen for these companies. They do that within the context of the app stores, whether it's the Google Play Store or the Apple App Store. But maybe on YouTube, you guys have been getting these annoying these annoying ads for mobile games. Yeah, that's probably AppLovin software targeting you, right? The CEO, Adam Ferogi, suggested on the earnings call that another wave of growth is likely on the way due to the legal saga between Apple and Epic Games, something that was settled last year in Europe. The idea is that developers are no longer being forced to pay Apple's 15 to 30% take because purchases can be made outside the App Store, so they'll be willing to spend more on advertising to find new users. That plays into AppLovin's market. Here's what he had to say. You'll start seeing it compound pretty quickly in terms of benefits to us as an ad platform, said the CEO. Once the very large leaders start doing it, meaning spending more money on marketing, right? you'll start seeing these smaller ones, the smaller sized ones, really pick it up quickly. And as we said, net income more than doubled to $820 million. That was the highlight of the quarter. Now, of course, now they go into several things that, some short sellers were publishing on the company, saying that they were implicated in some dubious practices in terms of how they were advertising and stuff like that. But then the CEO just last quarter kind of jumped on and wrote a blog post defending his company. And pretty much saying that they were nefarious short sellers and that they were making false and misleading claims and trying to undermine the company, essentially. All that is kind of noise and water under the bridge at this point. Anything that AppLovin is doing right now, I mean, upon peer reviews and whatnot, seems to be legit. Are they kind of tweaking some integrations here and there to be a bit more favorable for them? Yes, but a lot of different companies do that. They're not really alone. In terms of their numbers, guys, their numbers were really, really, really solid. You'll see here that they're reporting revenues of 77% growth, whereas before I did say 17. Why is there a discrepancy right here? Well, simply, guys, they're only reviewing their advertising business because right now they have now sold their apps business. This company has two lines of business. Number one is pure advertising. Number two, they used to have what they called either a gaming business or an apps business. They would develop free-to-play apps, but then within those apps, they would try to monetize the heck out of the content. So upgrades within the app or advertising within the app, and that revenue profile looks something like this. So the blue chart, right, the blue bars right here are the software platform revenue, aka their advertising division. That is the one that's really been growing excessively fast for the company. The green and orange, or sorry, the purple and orange right here is in-app purchases and in-app advertising. It gives you a summary in terms of the app's revenue. This is the division of the company that they're selling. They're offloading it. Why? Well, because it has not seen the amount of growth that the advertising segment has had. So they've now just divested this business to the tune of $900 million to a company called Triple Dot. That was $400 million in cash and a 20% equity stake in Triple Dot. So they will retain an equity stake that they'll be able to maintain on their financial statements, essentially. But just showing you the contrast, right? The apps business was declining and the advertising business was really rallying. So when they talk about 77%, essentially what they're doing is they're removing the impact of the ads business overall, of the apps business overall. So only advertising. That's why you see a very strong headline number as reported by them. Net income was obviously up 156%, which is very good. And cash flow right now generated $772 million of free cash flow, which is good, but in relation to their market cap is very small. You can see, I mean, from this overall chart here, guys, it's very solid. Net income from continuing operations is solid as well. Here is your operation margins, which is very, very, very strong right there. EBITDA also up and to the right. And cash flow and shares outstanding. You can see here that they are making more and more free cash flow per quarter because the company is wildly profitable right now. They don't really have too much debt at all. Shares outstanding, still flat though. They haven't really started buying back any shares or any of that good stuff. Company is still early in its growth phase and is overall looking quite good. So nothing bad to say about AppLovin. They have a tremendous amount of customers currently, but they are still not the biggest player, neither in the entire ad space, nor even in their niche. Here's some fun facts here from Grok AI. Google Ads and Meta dominate the broader digital advertising market that everybody knows, with massive advertising revenues, which Meta and Google represent 50% of the total advertising landscape right now. AppLovin holding only 3%. But that's total ads. Let's niche it down a little bit to mobile ads. Not only gaming, where AppLovin excels, but just pure mobile ads as a whole. AppLovin has an 8.38% market share, trailing behind URX, who has 57.5%. If you don't know what this company is, they were actually acquired by Pinterest several years ago at this point. They have the dominant landscape share of the entire mobile ads network. AppLovin is the primary player in specifically the gaming niche for advertising in terms of on mobile games and stuff like that. But still, they are also behind Google AdMob, which is at 11.72%. That's the entire mobile ad network category, but they are the dominant player in their niche, which is gaming. AppLovin's leadership is more pronounced in mobile gaming, where it serves 1.4 billion daily active users, which is insane. And they've been recognized for delivering a superior engagement compared to social media channels. All in all, though, guys, AppLovin, fantastic quarter. Advertising business for them is doing really well. They're the dominant player in the niche of the niche, which is, their niche is mobile ads, but the niche of the niche is gaming for mobile ads. Anyways, they're a dominant player. If you take a look here at their balance sheet, very strong overall. Nothing bad to say about the company. They don't really have that much debt. They will be able to pay that down with the sheer amount of free cash flow and profits that they're making. So the balance sheet is not too bad at all. They have a little bit of cash currently outstanding on that balance sheet too. In terms of the growth is really strong. Look at this ramp in EPS. They'll be almost tripling their EPS from this year into 2028. And in terms of revenue growth as well, very solid revenue growth. I know you can't see it because my head's in the way. 2025 to 2028, you are practically almost going to get a doubling of revenue, which gives them very solid growth rates for the next few years. 20% per year on revenue and 38% on EPS growth, all things considered. So very, very strong numbers here by this company. However, is it a buy though at $4.35, despite all of the strong quantitative aspects, which are the financials, and qualitative aspects, the fact that it's a well-loved company by Wall Street. It's also a fan favorite for retail investors, and they just do really, really well in their niche, right? So a lot of the intangible aspects of the company in terms of the qualities of the company, the fact that they do have a clear competitive advantage as well in their niche. Is it a buy though? At $4.35 with using the financials, we're trading at a forward price to earnings of 49. If you divide that by their ramp in EPS here, which is 38% per year, you get a PEG ratio of 1.29. That's actually not bad at all, guys. Almost one could say cheap. If you look at the trailing 12-month free cash flow yield, even though they're pumping a lot of free cash flow, it's still only 2% because free cash flow yield is calculated as the trailing 12 months free cash flow dollar figure divided by the market cap. And the market cap is really high right now. It's a low yield. And the forward price to sales, which is another metric you can use for a fast-growing company, that's very high. So we have kind of conflicting information here. It is cheap in relation to price to earnings, but it's expensive in terms of price to sales. However, I still do like this one. 2028 price to sales is about a 14. Higher end of tech, guys, usually gets like a 12 to 15. So if you use price to sales, they're fully valued. In terms of the amount of earnings that they're driving, which are arguably a higher consideration for Wall Street, you could deem them to be quite cheap, right? However, it's not as good as a deal as it was back here in the month of April, of course, under $300. In the event we revisit the low 400s or under 400s, if we give back some of these gains, of course, right? Not bad. Here, for me, this one is a nibble. Not a short-term explosive swing trade with very short-term call options. Long-term portfolio position, there is an argument to be made here that yes, it can be. They have enough of a competitive advantage and moat in their own respective niche to carve themselves away as one of the companies that could be good for a long-term portfolio. And a lot of their growth will be had over the next 3 years. So if I had to build a share position here, I wouldn't mind, but it would be kind of like a slow nibble and a DCA, not shoving all in right there, but maybe a slow DCA. If we get some seasonality and AppLovin gives back some of its gains, if some growth stocks fall out of favor, and that's happened before, right? We've had several periods in time where it just consolidates. That is when I would accumulate some shares and then kind of just ride those shares into the next 2-3 years as a swing trade position, an extended swing trade position. Maybe not a company that I would keep for the next, 5, 10, 15 years, but in the highest portion of their growth phase, the fastest portion of their growth phase, well, second fastest behind this one, of course, I would not mind making this something like a 1 to 3 year hold. Those are my opinions on AppLovin. Hopefully you guys enjoyed that. Now, company number 3 that we're going to be taking a look at is a company that just literally went 3 standard deviations, meaning the expected move on this stock after earnings was 10%. 2 standard deviations would be 20%. 3 standard deviations is 30%. And if you guys know anything about statistics, guys, there is less than a 0.1% chance of this actually happening. But it's happened a lot, guys. I mean, just Fortinet, we'll do them tomorrow. Fortinet went 3 standard deviations today. So there's a lot of companies going up 20%, down 20%, but TradeDesk has to be one of the biggest swings that I've seen in a long time. I mean, unless you count 2 quarters ago. So twice in 3 quarters has this company been down almost 30%. Did they do anything wrong, though? That is always the question. You would expect them to be, for it to be a disaster quarter for them. As a matter of fact, no, the numbers were curiously decent, but there's a few little components here that we have to pay attention to. So in terms of their EPS, they actually beat on EPS 1.34%, and they beat on revenue by about 1.25%. However, we did have something that overshadowed these decent numbers, and I'll explain that in a few key minutes here. All right, moving on to the easy numbers for TradeDesk. Revenue was up 19% year over year, but slowing. Last year, it was up 20, and it's been up 20+% every single year for the past 3-4 years. The revenue run rate now is slowing in terms of the acceleration. So Wall Street had a problem with that. They've been having a problem with that for the past 2 quarters, but now that problem is coming front and center, which is why the stock was down this much today. At least there was a portion of it. EPS was up 5% year over year, EBITDA 12%, and customer retention still remains relatively high at 95%. Now, in terms of other news, did they miss anywhere else on guidance? No, actually, the revenue came in and slightly beat the guidance estimates, not by much, but it did. And EBITDA and EPS for next quarter as well came in at a slight beat. So did they miss tremendously on margins or something like that? Not really. 29.3% net margins, which is better than last quarter and in line with some of the company's historical average. So it wasn't even a miss on margins either. And they have been buying back shares. So what else happened today? Well, let's have a look here. We'll start it off with commentary by the CEO. Q2 was a strong quarter for TradeDesk, with revenue growing $700 million, almost up 19% year over year, as we continue to outpace the digital advertising market. Okay, the first half of 2025 has been defined by meaningful innovation across our platform. Kokai, their new platform, this was the reason, by the way, they dropped 30%, is because they swapped platforms from whatever the previous one used to be called to the new one called Kokai. And there was a bit of integration issues and migrating customers from the old platform to the new platform. Those issues have since been solved, but just explaining to you guys what Kokai is, it's helping advertisers drive better results by integrating more data into every decision, using AI as a co-pilot. So they used the word AI in the earnings release, guys, so it must not be that, right? And unlocking the full potential of first-party data. We've also made significant progress in CTV, which is legacy television, retail media, and the supply chain, empowering the world's largest brands and agencies to reach audiences across the open internet. They do business with almost everybody that you can think of, guys. TradeDesk is like an advertising wholesaler. They match the people who want to advertise to people who have advertisement placement space, right? So let's say you're, I don't know, Walmart, and you want to advertise somewhere, but you're not too sure where. TradeDesk has a bunch of people that are requesting for people to advertise on their websites or whatnot. So what TradeDesk is going to do is going to match Walmart or whoever with the person who has the advertising space. They'll match them together, give them a rate, and then TradeDesk collects a fee, of course, right? So they're a middleman in advertising, essentially. With the continued innovation in Kokai, growing adoption of OpenPath, their new software, and deeper partnerships across the ecosystem, we're delivering exceptional value to our clients and helping to strengthen the open internet in the process. Here's one thing that the market just didn't like. The prior CFO was replaced by a new CFO. But was he replaced by someone not qualified for the job? No, the person that they replaced him with has 2 decades of experience as an investor, operator, and board member for leading global technology companies. Okay, that's all good, but has he been with TradeDesk before? Well, yeah, he's had a long-standing relationship with TradeDesk as an early investor since 2014 and a board member since February of 2025. He'll remain on the board of directors while also serving as CFO. He most recently was a partner at Lightspeed Venture Partners, previously spent nearly a decade at Salesforce, so he definitely knows about enterprise software, including as a senior VP and managing partner of Salesforce Ventures. So that's who they're bringing in. Apparently, the market just really didn't like that. And by the way, when these numbers were released, there's something fishy going on here. Because immediately, as soon as these numbers were released, and they were decent numbers, it wasn't a, slow and methodical drop like you see sometimes. No, instant. So in 3 minutes, guys, the algorithms were pre-programmed for this for some reason, of which that reason is still unclear. But there's something definitely funny going on here with this earnings release, right? Before it actually hit the tape, there must have been a lot of sell orders pre-prepared because there wasn't any buyers whatsoever to counterbalance that action. That was very strange. I found that very strange. But anyways, I digress. You can see a slowing down of the revenue growth rate here. Last year was 26, this year 19. One of the first year-over-year rates under 20% for TradeDesk in the last 3 to 4 years at this point. 6 months ended. You can see that it's still higher than 20 if you measure in terms of 6 months, but still off the 27%. Into the future, into next year, guys, the problem is, with the forward guidance and the expectations, revenue is only going to be in the teens, talking about 15, 16%, which is a net deceleration from 20%. So the company is decelerating in terms of revenue. Those two things, the CFO and the deceleration of revenue, is enough to bring the stock down 30%. So please keep that in mind. Now, in terms of their margins were fine. Gross margin up here in blue, the operating margin here in orange, and the net margins down below here. Keep in mind, guys, that these are the GAAP margins. So what I gave you before in terms of this headline right here, these are the non-GAAP net margins overall, the non-GAAP net income. TradeDesk kind of reports both of them. It's kind of a bit strange, but we'll get into that as well. So here you can see, but in terms of the consistency, right? Whether you take GAAP or non-GAAP, is it consistent? Well, it has been consistent, far better than it was in 2022, and kind of back to what it was pre-2020, pre-2019 overall. But gross margins definitely have not suffered, so it's not a margin problem. Moving into some of their slides, you'll see that they do focus on robust revenue growth right here. Revenue is growing, but it's slowing. It's not as fast as it once was, right? Now, keep in mind, this company partners with almost everybody under the sun. Like, if I just show you how many people they partner with, they say we buy the whole internet. So they will advertise everywhere for everyone as well. Extremely, extremely well-diversified company here. More of the brands that they partner with. So many people use the TradeDesk, guys, which is why it's surprising to see that, unfortunately, the revenue rate is declining. But I mean, high teens is still very, 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 very strong, right? Moving further into a few more of their slides, sustained profitability, as we saw from the prior graph. Profitability is not a question. They grow every year. It's not as if they're trying to scale revenue, and as a result, their operating expenses going through the roof. They're really not. And this chart kind of shows that as well, right? GAAP, non-GAAP net income, and earnings before interest, taxes, and depreciation and amortization, EBITDA anyways, are going higher. So very, very curious to see this drop today on TradeDesk. They still reiterate the fact that advertising total addressable market is a $1 trillion market, and that they will be there to kind of keep grabbing a big piece of that pie. Overall, though, guys, I mean, growth was pretty good, right? Top 20 worldwide advertising markets are all growing well. TradeDesk has a significant portion of the market making, essentially, capacity for the overall market, whether domestically and abroad. There's not much other numbers here. I pretty much showed you all the salient figures for that. So, you know, it's very tough to find anything in TradeDesk's report today that leads to a 30% drop. Okay, 10, 15, which was the expected move. Yeah, probably. But 30% in 3 candles, 3 minutes off of those numbers, a bit curious, guys. And the valuation is not terrible. I mean, it was a bit expensive here at $88. At $65, $62 right now, it's not that bad. So let's have a look at the valuation, shall we? At $65, they're trading at a forward price to earnings of 40. Their forward PEG ratio right now is 1.93. They're growing revenue at about 16% per year. No longer higher than 20, but 16 is still very decent. 21% growth in EPS. Gives them a PEG of 1.93 at $65. Still a little bit high, though. You would expect that a company that's currently still down right now, again, 55% from the all-time high, you would think that they're cheap. They're actually not as cheap as you may estimate. Price to sales at $65 is a 15. So also, guys, still not that cheap of a company. So even at $62, $65, guys, this company is not cheap, and a free cash flow yield, which is kind of very small, 1.85%. TradeDesk, however, does have some pretty good net margins. They do have a very interesting service, interesting platform. EPS is not doing too poorly. Revenue is also expanding very well. I mean, this EPS, this is kind of fake right here. TradingView, it for some reason was using non-GAAP, and now TradingView is using GAAP EPS. So it looks like there's a big drop off here, but there's actually not a drop off at all. The EPS is actually smooth up and to the right if you were to just maintain either non-GAAP or GAAP EPS. So this is a bit of an anomaly right there. It very rarely happens, but it is there. Figured I should explain it. But the company is somewhat expensive here. So is this company a buy? I mean, it has a very decent business model, guys. But if I'm going to go for an advertising play, I'll either go for Meta or for Google or maybe even for AppLovin. TradeDesk has a tremendous business, but they don't have the margins that AppLovin has. They don't have they also don't have the scale and sheer size that a Meta and that a Google has. So TradeDesk is kind of in the middle somewhere there. And if I'm going to go for pure play advertising, it's going to have to be AppLovin or Google or Meta or a combination of all three. It's tough for me to make a compelling argument here for TradeDesk alone, right? Especially at these valuations. I mean, when it was down here at like 50, 45 bucks, I was interested. But here at 62, when this company has some of the same metrics in terms of valuation that we just saw on AppLovin, or that you can find as well with Meta, I'll kind of probably orientate myself to those two companies instead, right? So that's everything I had for you guys for TradeDesk. Hopefully you guys enjoyed that. And with that, that wraps up all of our earnings calls. Hopefully you guys enjoyed, but a big overreaction here. I'm not going to be a buyer on this one. I'll just kind of wait for the earnings reaction to level out, kind of like it did back here, until we find some form of a tradable bottom. And at that point, I might reevaluate my stance for a short-term swing trade or stuff like that, but I'm not going to be touching it for now. That being said, that's everything for that one. Now let's move into the chart, shall we? Okay, so taking a look at the SPY, let me just move all this stuff over so we can actually analyze the technicals right here. You can see that the bulls have had a very, very nice push, a streamlined push from the lows on the Monday session, or on the Friday session rather, through Monday all the way until now. This is now a very nice retracement size, talking about a 78% retracement. Usually when you see such a very high retracement, it gives the bulls a very good probability of doing one or two things. Number one, either the full V-shaped recovery, or number two, the two-step recovery process. It does not guarantee it. It's just the higher the retracement size, the better the odds. So now they have pretty good odds of doing it, and you would favor the bull's capacity to turn this around into a new daily uptrend or a full V-shaped recovery. We are still closing above the 12 EMA, which we've recaptured after losing it in a meaningful way for the first time in the last couple of months, right? But the bears, the door is still open, guys. We don't have any macro news releases tomorrow to kind of send us down, but pay attention. We got CPI next week. So the door is still open here. Pay special attention to this line in the sand, 619. If you flush this level over the next few days into the next week, that is a daily downtrend, and that will head into more weekly consolidation for the markets, which would not be so crazy considering that, the month of August is usually pretty choppy and that we do have that CPI report coming up. So keep that in mind. The below support on the weekly, a lot of it, 611 all the way down to 598 is looking for a weekly higher low, and your higher lows all the way down here, 591. So the bulls with a lot of space, a big support area in the way, and the weekly 12 EMA that can act as a bit of a defensive factor as well. On to the QQQs right now. So QQQs, same concept, big retracement by the bulls right now. This is almost 100%, guys, looking very strong, which means they have very good odds of either doing the full V shape or at least the two-stage recovery process, setting a new higher low and possibly moving on to a new daily uptrend. In the event that you unwind, though, pay attention, your line in the sand level remains 550 flat. That's all of these lows right there and your most recent higher low. So in the event you unwind this over the next week of action, you're just going to be looking for a very healthy weekly consolidation period. Anything above 522, looking for a new higher low for further trend continuation. And we got a lot of support down there. Prior all-time high resistance area, 536 down to 512. I know it's a very wide range, but just goes to show you how much space the bulls have and how much of a range of defense they can actually play. The markets are not looking too bad, but it's still anybody's game as the battle between the two narratives rages on. Moving into financials right now, very bad day after Fed member Bostic, was speaking this morning. Essentially, very poor day from financials. I mean, a company like Visa today was down like 2.25% just because of his comments on the consumer, essentially, right? But we literally just had Visa's earnings. They told us themselves that the consumer was pretty good, not over leveraged, and these sales numbers for Visa were actually very, very, very good. So that being said, guys, Visa for me is a buy at these levels, 335 down 330, very solid buy area for Visa. We're revisiting some of the locations we had prior in the month of April, and Visa also testing a very rare EMA here, the 12 monthly EMA, traditionally always a decent buying opportunity. Now, some of the banks are also consolidating. The whole sector has been somewhat weak. Line in the sand level remains 5106. You flush that, you end up in the daily downtrend. You also would lose something else. The weekly higher lows, which we've been battling with ever since last Friday. If you lose that, sadly, you're unwinding the weekly uptrend. You're going into more weekly consolidation. Good thing, though, the bulls have a lot of space still. Anything above 50, is into the similar support range. And even if you break this range, guys, the clearest time frame for financials is the monthly, right? From the bottom of April to the top, that was a 26.5% rally on financials. Usually you don't get that quick of a move. If we unwind, probably heading close to the 12 EMA, which is about 49. So I'll be looking for some of my favorite companies in the process. Visa in around current prices. I'll be looking for MasterCard in around the 12 EMA, 541. I'll be looking for American Express as well. American Express probably right around here, under 300, 280. Not a bad time to be adding some shares to my long-term portfolio. The banks, I'm not really doing too much, but if other banks like Bank of America comes back down here, let's call it like the 43 area right here, maybe you'll find me writing some short puts. They were on the top 5 options watch list last Sunday. And if we do continue weakening throughout the rest of the Friday session tomorrow, you'll probably find this one on the top 5 options playlist again, almost daily oversold on Bank of America. Into healthcare right now. So Eli Lilly was the final drop in a very deep bucket of healthcare sell-offs right now. That being said, we have now cracked the 130 era. You can see that we have not closed the week below 130 since April, since all of the volatility started in healthcare. We have not closed the weekly candle there. If we do close this, guys, tomorrow, that will officially be a new weekly downtrend. And sadly, your monthly lows have not been found just yet. It will still be a continuous erosion here of the monthly trend. And you're still looking for the lower bulls down here to act as defense. So far, they've been doing a good job, right? All of these guys from 2021 through 2024, almost 2.5 years of support, culminating in that 122. I've been referencing this 50 EMA. Usually when healthcare comes below this 50 EMA, it's a good time to be buying. The healthcare sector is very cheap right now, but rather than invest in individual companies, I'd rather invest in the entire sector. The sector is still down from its highs 18%. It is extremely cheap. The whole sector has been the cheapest that it's arguably been in like the last decade. So keep that in mind. I might bring some numbers for you guys tomorrow, some statistics on how cheap it actually is. Semiconductors today, not too bad, 1.5%. And semis coming back, guys, right? So trying to go for the new daily uptrend, and they got it, closing back above the 12 EMA. We were in serious jeopardy here of losing the uptrend, right? And possibly going into further weekly consolidation. We're still not out of the woods yet. It's just sideways consolidation on the SMH. In the event that you roll over with a further battle between the bulls and the bears, and you roll this over again, you're simply looking for a weekly higher low. The clearest time frame for me is the weekly 275 down to 272, 12 EMA, and the prior all-time highs there. The cleanest one, though, is probably the SOXX, which has a more balanced approach in terms of its holdings, the weightings of the holdings, right? Looking for a weekly higher low, tons of support, 236 down to 215. As a result, I will write SOXL short puts every single week on most red days and just try to farm some of that juicy premiums, or maybe on even some individual names, right? Micron, if it keeps coming back down here, low 100s, I'll keep farming some short puts there. We've been playing it a lot in the last 2-3 weeks on the channel, but also in my Discord. ASML is not for short puts, but ASML, good buy here, in my opinion, for a long-term portfolio. And, if AMD starts coming back a little bit more too, back down here into the 150s, I'll do some short puts again. I actually did a contract yesterday, and just today we were already out of that contract. So making some decent money on AMD on the pullbacks. I'll continue to play it down below there. Just want to reiterate that most dips in semiconductors, especially on your favorite names, are probably for buying, but the data center ones more specifically, right? Because we know the rest of semis in the last month, they've really been struggling. So I'm not playing anything else. I'm just playing the more favorable ones. Hopefully that makes sense. Moving into the Russell right now, Russell down 0.33, but it's been a challenging week for the Russell overall with the battle of the narratives, right? I mean, in one situation, if you get a recession, consumer slowdown and whatnot, and interest rates are just not able to be brought down by the Fed just yet, well, then the Russell's not going to go anywhere. Arguably, even if you do cut rates, but with a weakening consumer, the small caps are probably not going to do so well, which is why it's a very cloudy trade, guys. It's a very cloudy trade, in my opinion. So I'm just not participating right now. That being said, daily downtrend looking for a lower high and maybe a revisit of support down here, 217 down to 208. Very, very choppy for the Russell overall. The weekly trend is still quite clear. The bull's in control and still hunting for that infamous weekly higher low. But right now we seem to be trapped between overhead resistance and current support. And until these narratives kind of clear up, I don't believe we're going to get a break of either one of these two levels. We might just be stuck in this range, similar to what's happened the entire month of July as well. That's it for your index rundown. Hopefully you guys enjoyed. The VIX, I mean, you got the pop early morning, but once again, selling it off. And a few times this week, we've had early morning pops on the VIX, just for them to kind of be sold off into regular trading hours. Now, we are slightly more elevated than perhaps we were a few weeks ago, but we've kind of come back down into the average trading range of the VIX over the last 1 to 2 months, which has been about 16. The next big catalyst for the VIX for any expansion would be a weak CPI print, meaning a higher than expected inflation rate. And that data comes into play. I'll just show you guys, right? For next week, there's a couple things to keep an eye out for, but the next big volatility catalyst, Tuesday morning for CPI could be the next VIX expansion catalyst. But for now, unless we get really bad news tomorrow from something, which would be surprising, because there's nothing on the calendar tomorrow at all. I'll show you this week, right? This week, there's nothing on this calendar for tomorrow. Absolutely nothing. Just Michigan consumer sentiment. Okay. People haven't been paying attention to that since March and April, essentially, quite frankly. So that's the next catalyst for the VIX. Pay attention to it, right? On to the 10 and 20-year yields. I mean, yields are still just doing a whole lot of nothing. The 10 and 20-year really mixed today. So it's a push and pull, right? Bank of America only seeing maybe no interest rate cuts. Fed member Bostic seeing maybe 1 rate cut. The market pricing in 2 rate cuts. So the bonds are just all over the place. In my opinion, unless you get a clean break of 4.2 and a hold below on the 10, that's the market just being confused. And the 20-year yield, the same thing. Until you get a clean break below 4.7, I cannot say, all right, bonds are going to get a clean uptick higher and a sustained piece of momentum higher. So bonds still in an accumulation range, but you got to have a lot of time on those trades overall. Moving into gold right now, gold trading right around $3,400. Sadly, they did not give us the higher low entry that I was looking for in yesterday's video. It's been a nice sustained move from the bulls right now, starting to close above resistance. 3,400 to 3,360 is that resistance. Maybe looking for a bit of a breakout, retest, and run. I'd like to see a bit more distance because right now, the bears can just swap this right back down and lose the range. We haven't truly claimed it, although we are at 3,400 now. So no trades on me from gold, but the longer term time frames are not looking too bad, right? A tightening up of the weekly, holding on to the 12 EMA. This, categorically speaking, is a bull flag, and you do have a bullish bias for expansion, maybe up to 3,500, but no swing trade positions from me. Didn't get the entry for the back test that I wanted. So as a result, I'm just not in a position right now. And if you were to start one right here with a target of 3,500, I mean, the stop is way too low, guys. It's like 3,267. The trading profile right now is equidistant. It's like a 1-to-1, right? Worse than a 1-to-1, as a matter of fact, 0.72 to 1. So that's why, right? There's no clear area for a stop loss other than down below there. So I do want a bit of a retracement down, and then I might play it for the expansion of the possible weekly time frame, as you can see right there. But the bulls are not looking too bad. Moving on to Bitcoin right now. Bitcoin up today, 2.06%. Not a bad day for Bitcoin at all. New daily uptrend on Bitcoin, challenging prior support, which is now resistance, but they're challenging it. 117 is the mark to watch. Daily uptrend, which is good. It means that your weekly higher lows have been found. And as I was saying, guys, this has been a very nice weekly uptrend. We were always looking for higher lows, not quite coming down and touching the 12 as we've had, as we've done sometimes prior, right? But still, that 12 is 110. So in the event that you unwind this, which is always possible, right? You can unwind this. As of right now, it's not looking bad, right? For further expansion by the bulls. In the event that the price action is too choppy for you, you might be able to do what I'm doing, which is on big red days on Bitcoin, I'm just selling put options down here into the clearly defined trading range. I do have all the Bitcoin that I need in terms of accumulation periods. Accumulated some there, accumulated some there, I'd accumulated some there, and I've been buying Bitcoin every single month almost, right? For the past, years and years and years at this point in time. I have all the Bitcoin that I want. It's not looking bad. If you want to know my price target for Bitcoin over the next 1.5 years, so by the end of 2026, $200,000, especially in the context of a good market, is not that far-fetched. And altcoins having a good day today as well, as Bitcoin is now resuming its daily uptrend. So not looking too bad there. Now into our big tech names. Okay, so let's do Apple first, as always. So Apple up 3.2%. We talked about it yesterday as to why. It was some favorable comments by President Trump. So the action does continue on Apple today. Beautiful engulfing move by the bulls, guys. they have a chance now to reset the daily uptrend. Any move lower, if we reject from here, because we are into resistance, 232 up to 220, it's a big zone. It has been a big zone for Apple for a number of months now at this point in time. Rejection here, and now they're trying it again. In the event you get rejected, you got a lot of space right now. Anything above 201.50, looking for a daily higher low for possible further trend continuation. Are you late on the Apple Leap trade? Not so much, but still not getting as good as a price as we got back here and back here when we were calling out these opportunities on the channel for Apple to kind of attack this resistance range. And Apple's projections, at least probably for the next year, should be quite good. Looking forward to the new product offerings, especially the iPhone 17, which could see a better refresh cycle than the 14, 15, and 16 respectively, which contributed to Apple's slow revenue growth profiles over the past few years. Now, 10% revenue. We covered their earnings just about a week ago at this time, right? And it was quite good. If the weekly closes like this, guys, it's looking pretty good. Big demand zone being created right here. And Apple has a lot of catching up to do. The stock is still down 12% year to date. But when we were previously announcing this after earnings, it was such a good deal when it was 19%. You're not necessarily late on Apple overall, but there's still a bit of meat left on this trade overall. So not looking too bad. Congratulations to everybody who did buy the dip on Apple. Moving on to AMD right now. AMD recovering wildly after their earnings. And I was saying yesterday, this is probably a nice opportunity for some buys for either your long-term or to sell some puts down here. Now, we did do that in the Discord yesterday, and we made some decent change today on those trades. So not looking too bad, but who controls the trend? Still the bears right now. Still no uptrend being set by the bulls just yet. If they engulf, that'll be one way to do it. Or you'll just be looking for a new higher low, anything above 157, trying to set a higher low, trying to reverse this trend right here into resistance again, 184 to 170 right now. So short-term trend, a bit unclear right now. The weekly candle is looking good though, not even more consolidation than that. If however, the bears give us a round number 2 and we go for weekly consolidation, anything above 134, looking for a weekly higher low for further trend continuation, not looking too bad. If you're looking to trade this one, you're either looking for a back test or you're looking for the breakout retest. Two nice trade opportunities that give you a more clearly defined stop loss rather than just buying swing trades here into resistance and crossing your fingers. At least if you're short-term swing trading. Long-term positions, though, do remain a net buy for me at this current time at 170. I mean, we did the valuation at 150 because that's why I wrote my puts yesterday. But anyways, at 170, the valuation, we did it after earnings, still quite manageable. The company has a big run rate in terms of revenue growth and EPS expansion growth ahead of it. Moving on to Amazon right now. Amazon up 0.37% today. Not the worst day for Amazon overall, but getting rejected a bit at a resistance. We talked about it yesterday. 227 down to 218 is going to be that resistance range. It's these guys from all the way back there. If Amazon comes back down, the retracement size is not too bad so far, right? About a 50% retracement gives the bulls a 50% chance of trying to make an attempt to reset the uptrend. And if they can't do it and they flush, well, you guys know the drill. Just heading for very healthy weekly consolidation, anything above 206. Further weekly consolidation, not too bad. The weekly bulls are still in control of this 3+ month long daily weekly uptrend right now. And even if we go a bit lower, guys, and challenge the weeklies, you're just looking for a monthly higher low. The monthly's looking pretty strong right now. Anything above 160. Higher low, maybe down here into the low 200s. If it hits low 200s again, 210 or under, I'll be looking to sell some short puts in the market, but also looking to add some more long-term shares to my portfolio. On to Google right now. Google up about 0.18%. Not the best day for Google, but they're holding the highs. The bulls doing a very good job of retaining the resistance range. 194 down to 186 is that, support range for the bulls right now. Not looking too bad. We will see how they close this weekly candle. The weekly bulls are still well in control of this chart as well, continuing their expansion. And the daily, not too bad. The line in the sand remains 188. If you crack this to the downside, that's a daily downtrend. It'll be a loss of newfound support and just very healthy weekly consolidation, anything above 163, looking for a higher low. So if at some point during August, for any which reason whatsoever, I can find Google back down here, low 180s, I'll be selling some put options, but also buying some shares. But even here, for a long-term portfolio, not too bad of an opportunity at 190 to be adding. The valuation is still one of the lowest in the market. Moving on to Meta right now. Meta down 1.32%. It continues to be a big battle, but they are holding some of their earnings gains at least, right? Line in the sand is 746. If you lose that, daily downtrend and simply weekly consolidation. Meta has a lot of space though. Anything above 693, looking for a weekly higher low for further trend continuation. If we do come back down here, I will be adding some Meta shares, low 700s. And if you just break out from here, because that's always an opportunity, right? Well, you're going to 800 psychological, and I would not be surprised. Meta has pretty good numbers. They completely smashed their earnings. We covered it on the channel last week. Moving on to Microsoft right now. Microsoft, wow, one thing happened today, and you can probably tell from this chart, right? This is the first daily downtrend on Microsoft in the last 3 months. They flushed the lows, 523, closing below that at 520. Daily downtrend, not yet losing the 12 EMA. If you lose the 12 EMA and perpetuate this daily downtrend, this time is different. You might just be looking for a bit more weekly consolidation, the extent of which might come down first stop into the 12 EMA, right down here at about 491. Microsoft has had a tremendous rally, a million weeks of upside in a row without much pullback. If we do get a pullback, that might just be your first stop. No trades for me, and not any, and no swing trades for me, but also not any long-term portfolio buys. I think the company is pretty much fully priced at this point. You're not really getting that good of a discount. Moving on to Netflix right now, up 0.16%. Not the worst day for Netflix, but still rejecting from this resistance range, right? Resistance range stays planted about 1215, 1220, down to about 1185. It's all these guys from back there. Daily downtrend is significant right now. The bulls are trying to make an attempt, but if you get rejected, you wouldn't be surprised. They do have the daily MACD, though. That's not looking too bad. So what the bulls want to do here, give me a nice size bounce, right? This is the most recent weekly leg of selling, right? Weekly legs of selling like this. Now give me an engulfing bounce and reset the trend. Reclaim this resistance area as support. Set a higher low on the downswing into here. If that does happen, stop can go below there, and then you are targeting the weekly expansion phase again, because that will let you know that the weekly lows are now set, and that the bulls might just be looking for a turn of their own. But maybe we won't get all the way back to the all-time highs. Maybe they'll have to do a two-step process here as well. The weekly is not looking too bad, though, on Netflix stock. But, I mean, the bears are short-term in control still, so just please keep that in mind. Where I would be buying more long-term shares for Netflix, very close. 1,100 down to about $1,000 would not be a bad location. On to NVIDIA right now. NVIDIA up 0.75%. Pretty good day for NVIDIA. Right? Not yet losing any trend factors whatsoever. Still a clean daily uptrend. Your higher low is right there, 171. If you lose this without closing a new high above 182, that would be your first daily downtrend, and that would be weekly consolidation at the same time, which could send you down here, 158, 159, 12 EMA, and a bit lower. You have so much more support starting at about the 150, 145 area. I'm not saying it's going down there. I'm just saying if these things do happen, like Netflix, well, that is probably what you're going to get. NVIDIA with earnings at the end of the month, so still a lot of time remaining for those NVIDIA earnings. But as of right now, the bulls control everything. They control the uptrend. Very tough for me to position for swing trade longs right here. It's very extended. But any long-term shareholders need not worry. There are no red flags for this company. And the valuation, even at 170, is manageable. It's not cheap. It's not expensive. It's very manageable. No red flags at all. If I had NVIDIA shares right now or whatnot, I would be holding. I wouldn't necessarily be adding. I wouldn't be selling. It's just a hold for me right now. On to Tesla right now. Tesla up 0.74%. Not too bad. Tesla bulls are trying to reset a daily uptrend. Need a break of 329 to make that happen. The cleanest time frame, though, as we've been saying for the last few weeks on Tesla, is the weekly. This has been a weekly tightening range for a long time at this point, right? And there was a swing trade entry down here with a stop loss down below there. Why? Because that was your weekly low, right? Tightening up of the range. If you lose this weekly low, you invalidate that tightening range, which is also kind of a bull flag right now. And you go weekly downtrend and you go for more monthly consolidation. So far, the bulls are looking good. The next profit target, if you're into that swing trade, is 340 up to 360 resistance highs. Not looking too bad for Tesla. Moving on to Palantir right now. Palantir up another 1.48%. Daily RSI is currently sitting at about 78, so slight overbought conditions. In the event we do have a pullback, because pullbacks are always possible, right? Anything above 150, looking for a new higher low for possible further trend continuation. Where you might get a little bit worried in terms of short-term price action is if you set a daily downtrend, and then you would just be going into healthy weekly consolidation, anything above 129, looking for a weekly higher low for possible further trend continuation thereafter. Weekly is slightly overbought conditions as well. The risk reward profile of Palantir up here on a short-term time span is not the best at all. Let's just be honest, right? If you have a 3 to 5 year time horizon, then you might be able to justify some of the multiples that you're agreeing to pay right now. Moving on to SOFI right now, 2.89% to the upside. SOFI still battling right now, guys. Still trapped below resistance, 24.50 down to about 22.50, which is these resistance ranges from 2021. These range highs right there. We will see if the bulls have it in them. I mean, they're tightening up. They haven't really lost the 12 EMA in a meaningful fashion. Your line in the sand level, right? The area that you cannot lose if you want to maintain the bulls' momentum right now are these guys right down here, 20.6, let's call it, right? If you say a breakdown below 20.6, clear loss of the 12, clear loss of the daily uptrend into a downtrend, and at that point, you'll be heading into very healthy weekly consolidation. The first stop, probably the 12 EMA, and then maybe the next stop, some of the 17, high 16 area down there. I will be a buyer of SOFI if we do come down there at this current time. And if you are a long-term investor, is buying SOFI here at $21 a decent proposition? Well, it's not a bad proposition. The risk reward is still okay if you have a next 2, 3, 4, 5 year time horizon. I think this company can easily be worth, anywhere between 30 to 40 billion dollars. So the upside definitely is there. If you're a long-term SOFI shareholder, it's just if you're looking for short-term swing trades, I mean, the fast-paced growth, guys, is probably not going to happen in the next 2-3 months. You're not going to shoot up another 2x. But still, you could see some decent gains. It's just buying into resistance is always tricky, especially when you're trying to do it with short-term calls. On to Uber right now. Uber up 4%. They recovered a lot of their earnings slide yesterday and now moving higher. We had a daily downtrend. The bulls have now engulfed this most recent leg of selling. So in the event we get rejected here, you're looking for a new higher low. Anything above 86, let's call it, looking for a new higher low for further, or rather a new daily uptrend formation right now. The time frame that was the most clear, this whole time was the weekly time frame, right? Beautiful weekly expansion. This was a bull flag, another leg of expansion looking for a higher low, anything above 83, higher low, and now you're looking to expand. Next price target right now is going to be $100. I was commenting after earnings that Uber, as a matter of fact, was indeed a buy. The valuation was very, very decent, and they showed extremely good numbers, guys. Uber is still one of my favorite stocks into the next 2-3 years. Even in spite of the robo-taxi competition, which they are embracing. We heard that on the earnings call yesterday. It's just that it's a bit tricky to position right now for a trade, right? I mean, the stop loss would have to go at 85, and then you're charging $100 psychological, right? So what is that? $8 of reward, $7 worth of risk. The risk reward profile is not the best at the current time. And lastly, moving into TSM. So TSM up 4.86% today, largely retracing any losses from the prior sessions, right? So TSM had a daily downtrend underway, and now the bulls engulfed in one clean shot, reclaiming the 12 EMA. So weekly consolidation was sideways, but the bulls never lost much ground. That's also another way you can consolidate, right? You can either go, you can either go down or you can just be flat. This is somewhat of a bull flag as well. Pay special attention, though, in the next few days of trading. If you break 229 again, you are going to go into the furtherance of a daily downtrend and just head a bit further into weekly consolidation. Good thing, though, the bulls have an area of confluence below, talking about 220 highs, and the 12 EMA is down there as well. Maybe, who knows? Maybe we just consolidate sideways until the 12 comes up to us. In terms of a short-term swing trade, it's really tough to position here without much of a discount. But in terms of a long-term portfolio position, not bad. The valuation of TSM up here is not bad. I was saying that into the low 230s as well, it was pretty decent. So it's an add in terms of long-term shares from me, right? It's not a full send buy right now, the same as it was back here, but it's an add. Still, the valuation of the company is quite good in relation to its future growth prospects, even in spite of the fact that it's at the all-time highs. And that wraps up all of our plays for today. Hopefully you guys enjoyed the index rundown, the earnings rundowns, the big tech rundowns. Now, let's dive into some of our biggest gainers and losers of the day. Okay, let's start off with the biggest losers of the day, shall we? And of course, we have to talk about Fortinet. We're going to briefly talk about it today because I'll do their earnings tomorrow. Fortinet, though, coming into a very decent level of price action, talking about the 200 weekly day EMA. Usually, the stock has benefited from a bounce from that area, and it happened today as well. Why they were down so much? Well, it's because of the guidance that they gave about a year ago at this time. They were saying that because of the AI ramp, that they were going to have a ton of business in the hardware and networking applications of cybersecurity. So contrary to SaaS applications of cybersecurity, such as Palo Alto Networks and CrowdStrike's, these guys, for the most part, sell a lot of hardware. The reason why they dropped, well, they said they were midway through the massive cycle that they were projecting possibly to extend for the next 2-3 years. They've already gotten through half of apparently the demand in just the last 9 months. So the guidance was really disappointing, which led to the big sell-off overall. But there is a little bit of an opportunity here. I benefited from today's drop to sell some puts for next week down here at $65. As a matter of fact, I was able to close those profitably within one single day. But there could also be a bit of a swing trade using the lows of today as a proxy if you're trying to play a bit of a bounce. Not too bad of an idea overall. Just keep a tight stop loss because obviously playing earnings after the fact can be quite volatile. Some people use the 3-day rule, right? But you can just trade with a stop loss below here. Seems to be the absolute flush level. Daily conditions are down to 16. So trading with a stop here, maybe until the top end of the next resistance zone, 83. Not the worst proposition, or maybe for a longer duration trade. The company has good net margins, but they do trade a little bit expensive. But then again, the whole cybersecurity industry does trade also a bit expensive. But we'll tackle a bit more of Fortinet in tomorrow's video when we cover their earnings. Eli Lilly down 14% following. This was like the last one standing, essentially breaking down, guys, below a year's worth of support right now. Eli Lilly could be a decent long-term portfolio buy. I don't personally buy healthcare companies for my long-term portfolio, but Eli Lilly's product offerings are very large right now and is one of the more resilient companies in healthcare. That being said, they are a pharmaceutical play. You can see somewhat of a trend line right now that we're coming down into. So in the event we break that a little bit, we are into daily oversold conditions. And usually when Eli Lilly hits daily oversold conditions, I mean, they can get a little bit lower, but it tends to be an area where, accumulating some shares, if this is your style of a company, is not the worst case scenario. 610, 611 is that 200 weekly EMA. And you can see that anytime you would have bought this over the course of the past, 10 plus years since the great financial crisis essentially, has been a good time to possibly accumulate some shares of the stock. But once again, not my favorite. In terms of a short-term swing trade, guys, you're basically just trying to pick a falling knife right now. So it's an accumulation period for long-term shareholders, but short-term swing trades with the lack of overall support in this zone, I mean, the support is a bit lower, right? You'd kind of have to wait for the basing effects to kind of happen on the stock in around the lower 600 range. So not quite ready just yet because we don't really have a clearly defined support level to be basing our trades off of, at least not a close one to the same effect as we have like the Fortinet one that we're into right now. On to Symbotic. Symbotic was actually down 13% after their earnings, but this company is pretty solid, guys. A bit of an overreaction as well to their earnings. There is a clearly defined level that we can take some trades off of right now. Stop would go below the 47 area, and then you'd just be targeting for further expansion of this trade. Very solid company, very popular with retail investors right now. It's just that the earnings was a bit of a sell, the news event for them essentially, right? The weekly uptrend is still quite solid for the bulls despite of that earnings sell-off, which is why I say you got some good support here. Very good support here, right? So if we're looking to take a short-term swing trade with a stop loss, not the worst area. Why there? Well, because if you lose here, you lose the whole area. It invalidates the trade, and then you're just heading into more weekly consolidation. If you ask me where I'd be interested in this one, I'll be trying to sell some puts, low 40s, in the event that I can over the next few days. Talking about Figma now. Figma down another 13%. So I did something on this company today. I sold short puts for next week where, guys, all the way down here at 55. That's another 30, and I got 0.5% for them. That'll be another 30% sell-off by the end of next Friday and would give a much more manageable valuation of about $28 billion. Suffice to say, the bears are in clear control of this post-IPO price action. The 4-hour is a clear downtrend right now. So you're just looking eventually for the bulls to find some sort of a equilibrium area. Is that going to be 75? Is it going to be 70? Is it going to be 65? I don't know, and I don't try to guess. I'd rather them just show it to us, right? Give me a 4-hour trend change, and then I can say that this daily sell-off is finished, and then we might look for a bit of an expansion trade, but it all starts with a reversal of the lower time frames. If you want to play it like me, you might just consider selling puts way under the market and benefiting from some of this post-IPO, some of this post-IPO volatility. Elf Beauty, we covered them after earnings yesterday. I said that this one was definitely an ad here. bit tough for some swing trades. For me, this one is kind of like a long-term position right now. We did almost fill the post-earnings gap from last quarter, but still, right? I mean, the area is very wide right now in terms of support, 105 down to 89. It's an area to accumulate some long-term shares, maybe even some leap call options, but short-term swing trades, maybe a little bit dicey because we can just consolidate for a little bit more. I would really like to see them bottom out and find some sort of a level right here, because we really don't have too much recent price action for a clearly defined stop loss for a short-term swing trade. Airbnb, I was talking about this one yesterday after earnings. This one is a buy for me for the long-term portfolio, possibly for some leaps, but just make sure you put a lot of time on them. So also considering the fact that we don't really have a defined stop loss area to trade from, I mean, we didn't really recover much of the earnings move, so I'll be waiting for some basing out of some price here and waiting for the reversal on the short-term timeframes. We are daily oversold though, so kind of keep it on the watch list is essentially what I'm saying. ASTS has earnings next Monday, but we have fallen off here, daily downtrend overall, and a bit of weekly consolidation, so I won't be positioning before their earnings. I would rather wait till afterwards, but you know, I figured I should bring it up because maybe some of you are going to ask me. I'm not going to do anything before this company has earnings, guys. Twilio had their earnings today in the after hours. They're down to 108. For me, Twilio is kind of a buy down here, but it would have to come a lot lower, guys. I'm talking about like lower 90s. If you want to get me interested in Twilio, give me like lower 90s, 95, 90 to sell some puts into. If not, I probably won't be interested. Just thought I should bring it up. No clear price action, unwind of the weekly timeframes as well, right? Beautiful weekly uptrend right there. And now we've just unwound. So it's a bit tough, right? When you lose the weekly, you're just going into a bit of monthly consolidation. As a result, I might be looking to revisit this one in the 90 range. And then, of course, we'll talk more about cybersecurity tomorrow, but CrowdStrike for me is a buy in the low 400s, like for a long-term portfolio, not for a short-term swing trade, because who's in control? Well, very clearly, the short-term bears are in control, right? So you're just trying to pick a bottom. For long-term shares, though, not bad, especially in the lower 400 range. I would be looking to kind of pick that area. It's weekly consolidation right now. You're just looking for a monthly higher low. The 12 EMA and the support area is right down there, 400. So I'd be looking for kind of like a 400 in that range. FICO for me remains a long-term buy opportunity for a long-term portfolio. A little bit of a nibble here and a bit more of a nibble down here, 1,100 to 1,000. I think this sell-off is largely overdone, and it probably will be winding down here over the next few weeks as the bulls try to find a bottom. But I'm not going to try and pick the bottom here and go for some short-term swing trade action. No, the bears control the short-term timeframes. I just don't think it's a proper thing to do right now on these stocks, right? And then you have a whole bunch of software ones that are selling off, but we'll tackle those on a different day. Names like CRM and the whole software landscape has just been super soft. CRM, the bears control all the short-term timeframes. Adobe, the bears control all the short-term timeframes. It just hasn't been a fun time for software as a service companies, guys, right? Weekly downtrends almost on everything, even CRM, weekly downtrends. So they're okay for longer term positioning, right? 200 EMA, not too bad. We're coming into some of the tariff fear lows, but short-term swing trades, not for me just yet, not while the bears have short-term control. And now moving into the top end of the list right here, the biggest gainers of the day, Dutch Bros. Dutch Bros, good company, guys. If you ask me my thoughts, it's a good company, but I wonder, as per their capacity to expand internationally. Great company, some good growth metrics. Maybe we'll cover it on the Monday session. $11 billion market cap. The company's not even doing it's not even doing $1.5 billion, I think, this year, which is, I mean, it's okay, right? If you take a look at the numbers here, it's about $1.5 billion. So I guess I was slightly under the estimate there. 1.6 billion. I mean, it's trading at what, right? Like 11.56. So let's just do it real quick. 11.56 divided by 1.6 billion in sales is a 7.2 price to sales. It's not bad. I didn't mind Dutch Bros down here in the 50s, but I'm probably not going to be a buyer of this one into the 70s. I assume it could be some form of a decent swing trade, like the next 6, 12, 18 months type of thing. But the valuation is kind of up there, especially on the PE ratio side. And as I said, like they do well because of their drive-through business model. But I'm curious to see, like, can they expand that internationally in markets that don't really do the drive-throughs as much as we do in North America here? I don't know, but maybe their growth rate, at least domestically in the US, can be good for the next few years, but not my favorite play. NBIS had their earnings, fantastic earnings, data center play, of course. They have some common business with CoreWeave overall, coming to a bit of a resistance range. NBIS is the same concept, right? Short-term swing trade, no, but if we do pull back a little bit more, or even from here, right? If we want to buy NVIS for like a next 1 to 3 year swing trade as the company really comes into the expansion of its business for data centers, I'm not opposed to that. The same concept as CoreWeave, right? I'm not opposed to playing these for like a 12, 18, 24-month timeline of expansion. Sometimes timing these rallies is a bit challenging for short-term swing trades, so I think you might be best served with either some longer-term leaps or just some shares that you're looking to ride the company's best expansion path, which is going to be arguably the next 2 to 3 years for each and every one of these businesses. CELH and AppLovin, we just literally covered. NVO, you guys know my thoughts on this one. Good company, but very long-term time horizon. Anybody who's buying shares here, I hope you're not predicting like a massive 2x quickly. Buys here on NVO, buys here on UNH, and several healthcare names. They're going to take a lot of time to recover. I'm not saying they're not going to do it, but it will be a very time-intensive trade. So make sure, right, if you're doing any leap call options, make sure you do them, not crazy out of the money strikes. No. You want to be very close to the money and put a lot of time on those contracts overall. Tempest AI has earnings tomorrow, so we might take a look at them tomorrow or after. And Oscar, we might cover Oscar tomorrow as well. I like Oscar. I don't mind selling puts on Oscar down here. And even for a bit of shares or, some longer dated leaps, which are very cheap right now, I think this is kind of like the fastest horse in the whole healthcare insurance race. So I'd rather put my money with them because it's much easier for them to 2x than it is for a company like UNH, at least on a short-term time horizon, right? So we're kind of running out of time here. That's everything that I got for you guys today. We'll try to do more of these tomorrow, and we'll do a lot more of these next week when we don't have as many earnings to talk about. But that's it for me in today's video. Hopefully you guys enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new. We'd love to have you back. We do these every Monday to Friday after the close. And last but not least, if you have any questions, please feel free to ask them down below. I'll be answering all your guys' questions tonight. So take care. That's it for me. Have a good Friday session. Hopefully you guys wrap up the week strong with many profits. Take care. See you tomorrow. Peace.